Thank you, Mr. Chairman. I would like to start by thanking my colleague from the other side of the aisle and the sponsor of this bill, Mr. Rothfuss, for his commitment to working on a bipartisan basis throughout this entire process. This bill has come a long way from when it was introduced, and I think this bill reflects input not only from our offices, but from stakeholders, other members' offices, and regulators. I would also like to thank Mrs. Maloney and her staff who were critical in helping us to get the language that is reflected in the amendment in the nature of a substitute, in which I believe will be supported hopefully by many members on both sides of the aisle. This bill, with the adoption of the amendment in the nature of a substitute, as you've heard earlier, in the manager's amendment, simply seeks to right-size the excessive burden of regulation placed on insurance savings and loan holding companies compared to the risks they pose to financial stability. None of these companies have ever been designated by the Financial Stability Oversight Council as posing a risk to the financial stability of the United States economy. Yet they are facing similar regulations by the federal government as they were, all because of the way they are structured. There is no reason, in my opinion, why a smaller insurance company like Ohio-based Westfield Insurance Company should face more regulations than some of the largest insurance companies in the country due to the fact that they have a small depository institution. Or why a company like Nationwide Insurance, a company based in the 3rd Congressional District of Ohio, which has around $250 billion in assets and a $7 billion bank, should be treated by the Federal Reserve like a $250 billion bank holding company. The regulation of insurance is different from the regulation of banks, and the Federal Reserve's supervisory framework must reflect this important difference. The Federal Reserve has historically never regulated insurance until recently. Within the past 10 years, when Congress transferred the regulatory authority over these insurance savings and loan holding companies over to the feds. By contrast, our state insurance regulators have regulated this country's insurance system for nearly 150 years. Insurance saving and loan holding companies are regulated by their state insurance regulators, the Federal Reserve, and the Office of the Comptroller of Currency. To be clear, the bill does not remove the Federal Reserve's authority to regulate these companies. It merely requires the feds to use their existing authority to tailor their bank-centric regulations to the unique activities of insurance. I believe the feds has a role to play in supervision of these companies, and the cost of an insurance company owning a depository institution is an extra burden of federal regulation. However, this cost of admission cannot be so high that it forces companies to debank. Thank you, Mr. Speaker, and I yield back.